savings in tiers. The first tier is to secure your well-being, to own a portfolio of assets that are going to secure your well-being. And then after you have that taken care of, then you can go to the next level, take more risk, and so on. That well-being, that purchasing power, has to be viewed in terms of inflation-adjusted dollars. If you're holding a debt instrument and, a cash-paying instrument, and it gives you a 2% interest and you have a 5 or 6% inflation, you lose money at 3% a year. So you have to look at that in real dollars. And you have to hold that portfolio in a way that is balanced to any kind of economic environment. And then the way I do it, and I remember, I didn't have anything. And then I start to acquire money and I start to think, okay, how many weeks do I have, months do I have, or years that I'm financially safe? And what do I hold it in? So, and then, once you got that taken care of, you can go beyond it. And I wanted it in a very well-balanced portfolio, that type of portfolio that does equally well no matter what happens. There are basically two big influences on markets: the growth rate and the inflation rate. Like if growth is going to be faster than expected and inflation is going to be higher than expected, you know that bonds are going to go down, and vice versa. So the way I look at it is there are those two big influences, and then I have 4 environments, and each one of them can go up or down. So there are 4 quadrants that I think of: rising growth, falling growth, rising inflation, and falling inflation. And I want to have a portfolio that will be 25% of my risk in each one of those so that I don't have any bias. And so I pick the assets that are going to do well in each of those 4 quadrants, and I hold them in a balanced way. And I tested that, going back actually to 1900 and so on, and you'll actually increase your buying power. That's the kind of thing that I think in the beginning. Then you have to also make provision for, taxes to some extent. So I say whatever that amount of money is, I want twice as that. So in case it goes in half, and I want to build a portfolio that looks like that for, X number of years that I have that, and that's the safe savings. And then when I go beyond that, then I'll take more risk. But I think that being safe, particularly in this kind of an environment, is important. And I would take a perspective of how to do that that's like the one I'm just describing. So there's these 4 quadrants: growth and inflation. If growth is less than expected and inflation's less than expected, you would like to own bonds. Okay. If it's higher than expected, you would not want to own bonds. Okay. If inflation is higher than expected, you would want to own assets such as commodities and gold and inflation index bonds. If growth is faster than expected, particularly if inflation is less than expected, you'd want to own stocks. So you get the idea. So if you look at the Silicon Valley Bank issue, it's not so much their issue as much as a worldwide issue. And what happened is that, what's a bank? A bank takes in deposits and then it takes that money and it invests it in things. And so they bought a lot of government bonds that had a higher yield than they were paying out in the deposit. There's a tightness of monetary policy, and those yields went up and the bonds went down in value. And then the amount they have to pay out went up in value. And so they went broke. And that is happening all over. That happens not only through banks as a whole did a lot of that, but insurance companies and so on all around the world. Same sort of thing happened in Europe. Same sort of thing happened with Japanese companies even buying US dollar bonds a lot. And so you have, if you were to mark those to market, you would have a terrible calamity. But what's going to likely happen is they don't want any more of those bonds, and we're going to have to sell more bonds because we're going to have a deficit. So when you have a deficit, you have to pay for it through selling debt, and there's a lesser demand for that debt. And I think that creates a problem in which either interest rates go up or the Federal Reserve's got to come in and print. And this is a problem that exists also in Europe with the European Central Bank, the Bank of Japan, all of them. So that's where we are. And it has knock-on effects. It's like dominoes that fall. So it will produce less credit, and as it produces less credit, that'll produce less spending. It'll come in certain parts of the economy. For example, commercial real estate. For example, venture capital and private equity. For example, low-grade bonds where they have a heavily indebted company and the interest rate goes up a lot, and that causes problems. So I think you're in the part of the cycle where you've had the tightening and the dominoes are beginning to fall. And I think that's going to produce more problems. So I think when it comes down to it, there's just too much debt and we're adding it to it too quickly. And so it's going to, either that debt will be paid off with hard money, in which case there's not much printing and so on, or it'll be paid off with printing a lot of money to make it easier to pay off. I think in the end, it's always the case that they print a lot of money and make it easier to pay off, but you have the reduced value of money. So that's how it looks to me. You'll have probably a stagflation environment. And because you have that dynamic going on at the same time as you have supply chain disruptions because of the geopolitical, I think it's going to be a difficult environment. The most important thing, as I say, is to have this basic, well-diversified. And, there's some assets and think about different, a small percentage of your money, even an asset like gold and diversification for countries, to create a diversified portfolio is important. Cryptocurrency or Bitcoin doesn't move in a reliable way related to almost anything. It, moves up and down because of this mood and that mood. Unlike gold, let's say, I would prefer gold and I would prefer crypto for various reasons. Crypto, it's very easy to track the owners and transactions in it. It's not liked by the government. It doesn't move in a way that's consistent with, kind of any of the environments. And it's a small asset class. We talk a lot more about it, but its size is about, 30% of the size of Microsoft, and Microsoft is one stock among many stocks. So it's given probably a lot more attention. I don't know, who knows? Maybe, there's some element of it. I don't understand why people are more inclined to go to Bitcoin than gold. If you look internationally, gold is, for central banks, the third highest reserve asset. First is dollars, then euros, then gold, then Japanese yen. And central bankers are buying gold and they're not buying bonds. And it's, timeless and universal. It's been there. So I'm not a fan of it. As I've said before, having a little bit, I have a little bit of it. But if you have a little bit of it, you have to think about those things. And, like I said, you have to be prepared for it to fall a lot, if it goes down 80% or something, but that limits the amount that you can have in it. So I don't know. I don't think a lot of Bitcoin. For about 55 years, I've been a global macro investor, and I learned that many of the things that surprised me never happened in my lifetime before. So when I would see certain things happen that were like that, I would go back in history and study prior periods. Studying, for example, the Great Depression allowed us to anticipate the financial crisis in 2008. Anyway, there are three big things that I observed happening that didn't happen in our lifetimes, but happened during the 1930 to 45 period. And they are the creation of enormous amounts of debt and the printing of money to pay for those debts, and it having its economic effects on inflation and growth. The second is internal conflicts over the largest wealth gaps we had since then, values gaps, and the rise of populism of the right and the left. Those conflicts, again, largest since that 1930 to 45 period. And then the rise of a great power, producing a great powers conflict internationally, with the rise of China as a great power, challenging the United States and with Russia. So the great power conflict, that also is the most that's happened since the Great Depression. So because those three things are happening now, and I didn't study them, I went back and I needed to study the cycles, what's happened over longer periods of time. So I studied the last 500 years because these big cycles take about 75 years, give or take about 50. So, and, like the rise and decline of the British Empire, the rise and decline of the debt. And that dynamic I shared in the book, and I also shared it in an animated video, which is called The Changing World Order. And that creates a path. Now, it's not just because they repeat in this way, but one can see the cause-effect relationships that are happening. And so that has pretty much transpired according to script. We can get into those pieces, but I'd say those are the three main ones. There were two others that had big effect that I paid more attention to that I'll mention. One was acts of nature in the form of droughts, floods, and pandemics. They were very disruptive when they happened, killed more people and toppled more empires or orders than others. And then also, of course, over a period of time, there's learning and producing new technologies that raises living standards. It's raised per capita income, life expectancy, and so on. But those five factors transpire in ways that we've seen before to create this big cycle. And it's if we can look at the cause-effect relationships, that's what I want to pass along, because I'm 74 years old and I'm in a phase in my life that I want to pass along the things that are of value. And I think this is an important thing. But yes, it's transpiring according to script. The dollar is held by countries in the form of debt. In other words, when you say I'm holding the dollar, you're holding a debt instrument. And when we have a problem with the debt instrument, a few problems with it, holding the debt instrument, those problems are that, first of all, as a result of what the United States was in the world, the largest trading country, the dominant empire, and so on, there's been a huge accumulation of dollar-denominated debt in dollars, therefore. And there's also been a lot of deficits that had to be funded, which happens by selling dollar-denominated debt, which a lot of foreigners and banks and others bought. And so they have a lot of dollar-denominated debt. Now, if you're a creditor, meaning an owner of dollar-denominated debt, you need to have an interest rate that is high enough to more than compensate you for inflation. And so the production now of a lot more debt and them having a lot of debt, and then also sanctions internationally, which means freezing dollar-denominated debt, all have created a reduction in the demand for dollar-denominated debt. There's also, concerns in the world about some of the things that are going on in the United States, and that's reduced that. As a result of that, you're seeing more transactions take place in other currencies. And if they take place in other currencies, then others want to save in those other currencies because that's how they pay for it. So if you want to save in what you pay for, you save more in it and less in dollars. And so that's the dynamic that is reducing the demand for dollars and dollar debt at the same time as the supply of it keeps coming because we have large deficits. So that there's a supply-demand issue. That supply-demand issue, by the way, also exists in European currencies. Okay, they have too much debt and they're financed the same way, and Japanese currencies. And so what you're seeing is the movement, all that weight of money and debt is causing prices to go up, inflation. And that's also being worsened by the supply chain deteriorations that are due to the international conflict. So, for example, in the case of, let's say, China and the United States and other countries, as they prepare for possibility of war, they want to be self-sufficient. And so as a result, they work on being self-sufficient more than integrated and efficient. And so that dynamic is playing an important role too.